Welcome back to Wook Capital Management's 23rd edition of our weekly Wook in Review. This is Managing Director Rod Alsman. I'm joined by my Chief Operating Officer, Han, and we're going to walk through this week's topics in a second. I just need everybody to be aware, though, that Wook Capital Management, Inc. and its employees solely provide investment advisory services to family clients and do not provide investment advisory services to the general public. Furthermore, investments are highly speculative in nature and involve substantial risk of loss. We encourage investors to obtain advice from your professional investment advisor and to make independent investigations before acting on information that we publish. We cannot assure you that the information is accurate or complete. We do not in any way warrant or guarantee the success of any action you take in reliance on our statements or recommendations. And of course, past performance is not necessarily indicative of future results, and all investment decisions of an individual remain the specific responsibility of that individual. All right, that mouthful out of the way. There was a whole lot going on this week. So I had to wake up and get it adjusted, the newsletter this morning, which I typically have it ready to go Thursday night. Again, if you select the link in the Wook Capital profile that has the little newspaper icon, that'll bring you to all of the newsletters. And you can access the last one if you're not signed up. Please feel free to sign up. It's not a service we'll ever be charging for. It's just a free smattering of kind of news of the week. So I've got kind of 4 different topics. We're obviously going to talk about the bank failure and what's going on there. We're going to talk about one of the Wook watch list companies that reported this week, Dole. We'll talk about AI. And then we'll talk about kind of macroeconomy a little bit. So those are the topics on the agenda. We're going to go item by item. And if anybody wants to come up as a speaker, share their perspective, any commentary or questions, feel free to do so. But I'm going to try to keep it topic by topic so that we can not jump around as much. So let me get my screen corrected here. Again, if you're following along, or if you'd like to follow along live in the Wook Discord, wook.gg will bring you to the Discord, and you can join the voice chat and see my screen. A lot of this is I'm not going to really be referring so extensively to what's on the screen, since I know most people aren't looking, but for the folks who are watching the replay, of course, they'll be able to see that. So this week, it was really a tale of like 2 halves. The week started out, right? We had the Fed chair testifying to Congress twice earlier this week about how he expects that the ultimate level of interest rates is likely to be higher than previously anticipated. So that is higher than what the Fed had said in their last summary of economic projections in December. So of course the Fed meets on the 21st and the 22nd, and on the 22nd we'll get a March decision for rates. But this week we saw a pretty crazy ride where rates priced expectations for a 50 basis point hike really went from not being priced in at all a month ago. It was pretty much a done deal that March would be a 25 basis point hike. Even just a week ago, going back to last Friday, it was less than 1/3 chance priced in that the hike would be 50 basis points. But then, of course, during Powell's prepared remarks, that message, and he slightly adjusted it after the Senate testimony for the House testimony to really emphasize that it's not a decision that's been made, but based on the totality of incoming data, they would be willing to go back up from 25 to 50 basis point hikes. So as of yesterday, the market was pricing in more than a 2/3 chance that it would be that 50 basis point hike. And then, of course, today it's flip-flopped yet again. So the market can't make up its mind. It's now, as of 4 o'clock Eastern time, Friday, March 10th, the CME FedWatch tool is from the Fed funds futures kind of pricing, current pricing is 62% chance of a 25 basis point hike versus 38% of 50. I'm inclined to think after what happened today that 50 is not in the cards. We're going to talk about the jobs report when we talk about the economy later. But obviously, what was going to be mostly a Fed-oriented kind of talking around rates changed drastically over the last 2 days with this bank run that's now led to the second largest bank failure in United States history, with Silicon Valley Bank, SVB Financial, which was the nation's 16th largest bank and was very heavily exposed to the venture capital space, basically going into receivership today. So I'm going to pull up a couple threads to kind of talk about why it got to that point and what happens next. So there was another bank that failed, that was liquidated this week, Silvergate, which played in the crypto space. So there's the kind of the commonality here is that, as I see it, and as I think the bulk of the investment world sees it, that these two entities, it was more idiosyncratic, unique risk to those entities that led to their failures, as opposed to there being some forthcoming system-wide bank failure. Obviously, anything can happen, as we've clearly discussed. If you put betting money down that SVB would collapse last week for this week, you made a whole hell of a lot of money. But kind of thinking about going back to why SVB failed, I mean, in a nutshell, and I pulled up a thread from Compound 248, which Compound 248 I think is a worthy follow on Twitter. He does a good job of covering both the technology space and just kind of happenings in the market generally. So he noted, right, the real issue that happened here is that Silicon Valley Bank took in a whole lot of deposits in 2019, 2020, 2021. So he noted that deposits tripled from 19 to 21. So they took in a whole lot of deposits. Okay, great. Banks take in deposits. What do they do with those deposits? Well, if they can't lend them out in the form of a business loan, a mortgage, whatever other type of lending they could pursue, then they're going to use the excess deposits to buy either loans like mortgage-backed securities or U.S. Treasuries. Now, the problem for SVB is that they bought long-duration securities, so 10 plus year duration bonds, which if we remember and go back a year, a little more than a year, 2001, early 2022, those 10-year yields were 1.6, 1.7%. So when yields rise, of course, prices fall, yields rise because of the inverse relationship there with bonds. So SVB's bonds that it bought depreciated in value meaningfully. The rates went higher. And then, right, if you're levered, which SVB and most banks are, and it was, and your assets, your 10-year bonds and the like that you bought have now depreciated meaningfully in value, you have a big mark-to-market loss. And then really what happened was there was a bank run. You had Peter Thiel and some other prominent Silicon Valley investors basically recommending and almost encouraging this bank run. Pull your money out, right? Obviously, if you have a deposit account up to $250,000, you're covered by a Federal Deposit Insurance Corporation, FDIC. But the vast majority, I think 90+% ish is the number of Silicon Valley Bank's deposits were not covered by FDIC. They were uninsured deposits. So the risk there is if there's a bank run going on and you're in there, the safe thing to do is to get your money out, even if you were hoping the bank would survive and that you could continue to do business with them as you might have done for many years. The prudent thing I think would have been once the run was going to get out of the way. And unfortunately, the FDIC this morning took SVB into receivership. So the other thread I have up, which I would encourage you to read from Bob Elliott. Bob Elliott is another good follow, I think. Bob E Unlimited is his handle on Twitter. So he noted that they're into receivership, which is not in of itself any especially unique thing. It happened. It happens hundreds of times over the last few decades. So the bank is closed, and unfortunately, people won't have access to their deposits over the weekend. But over the weekend, FDIC will figure out whether they're going to wind down or sell the bank, either chunks of it or all of it, to somebody else. So we'll probably hear news over the course of the weekend about whether there's a buyer or bidder for some or all of the assets of SVB. Either way, it doesn't matter, right? As we noted, the folks who have that 250,000 or less, that amount is going to be covered. They're insured, so they'll have full access to their insured deposits on Monday. And then the uninsured deposits, Bob notes that FDIC already said it will make an initial payment for uninsured deposits next week as well, given that it is in receivership. So if it remains in receivership, it'll get wound down, and then additional payments for those uninsured deposits will be made based on asset sales that eventually come. The best case, I think, would be that somebody opts to buy the bank, whether it's JP Morgan Chase, I think is the speculation I've heard most. But we'll hear more over the course of the weekend. For now, I think what it boils down to is clearly it injected a lot of fear into the market. The VIX, while it did close meaningfully lower than the highs, it was up almost 30% at one point today. It got not too far off of 30. So volatility certainly spiked. Asset prices, especially small caps, fell meaningfully today. So you look at the Dow, NASDAQ, and S&P, large and mega cap companies, the spread between those three, those indices were down 1 to 1.4 and change percent. Whereas the Russell 2000 small caps was down twice that much. It was down almost 3% today. So that was an interesting thing that I observed today while this was all going on, the underperformance of small cap versus large and mega cap. At this point, again, as I said, it does not seem like it's a systematic issue. These issues, this was poor risk management on the part of SVB. It was noted by some that SVB did not have a chief risk officer for much of last year. They clearly simply didn't manage their duration exposure and their maturities and the like well. So they just acted as a bad bank. I'm sure that they are not the only one, right? Silvergate, again, people with exposure to some of the frothier parts of the market seem to be the ones coming under stress. So whether it's crypto, venture capital, those are the ones that maybe we're going to see more issues in. Does it seem like the Bank of Americas of the world and JP Morgan Chases and Wells Fargo's will be failing on us and that we'll be in a great recession, depression 2.0? I mean, I'm pretty skeptical of fear mongering like that, but certainly not normal. It's not normal for the second largest bank failure in the country's history to happen. Pretty out of the blue too. So it definitely raises an eyebrow. Risk obviously flooded through the market today, and anyone who put some put positions on for SVB or like is probably feeling pretty good about their decision making. So I don't know if anybody has anything to add on the topic of today's bank failure or just the general landscape for banks. It was definitely a surprise to me. But I think that's in light of this, depending on how next week plays out, and I guess I'll leave this commentary till we get to talking about the jobs report data from this morning. But I just, even though the market's still pricing a chance of 50 basis points, it just strikes me as imprudent that the Fed would ratchet rate hike accelerate. They return to accelerating unless we got some really ugly CPI print next week, which I thought I saw that President Biden made a comment about it. So who knows if they already have that and they know it's going to be light or what, or if they're just trying to do damage control. We'll see when the data comes out next week. But I'm inclined to believe that 50 basis points is not happening in light of the events of today and the balance of, or as the chair would say, the totality of the data. Han, anything you'd add, or any kind of prompt questions you'd asked on this one before we move along, given I don't see anyone want to chime in on it?
Not much. I think that was a good overview. I'm still trying to follow what's going on with SVB and what will happen to the bank going forward and what this means for other fintech companies. We already see a bunch of fintech companies, including my my previous company, Payoneer. Stock fell quite heavily, and everyone's worried about kind of a similar effect, a ripple effect throughout the fintech community, and could be an opportunity. I think now is the chance to reevaluate, the exposure for these fintech companies, Silicon Valley Bank, and the companies with the stronger balance sheet that can weather the storm will come out as a worthwhile investment. While we'll probably see some fintechs, affected more heavily than others by the SVB situation.
Yeah, and unfortunately, it's just so funny to pick on Jim Cramer. He had, I think, a month ago when SVB was trading at like 300 something, basically said it was a great buy, and the Cramer curse struck again. And then this morning, Cramer tweets, "JP Morgan is a fortress." So, if we have another financial crisis, we know who to blame. But okay, let's move along then from that to the next topic. If we get through, the topics and people want to talk about SVB and what's going on in banking, we can circle back. But we obviously, just some programming notes. We covered the psychology of money, of course, 2 Tuesdays ago for our Wook Book Club. We are going to cover Joel Greenblatt's The Little Book That Still Beats the Market. So this is the second, kind of the updated version that he added some commentary after the great financial crisis, global financial crisis in 2010 or so. So Greenblatt's Little Book That Still Beats the Market. We're going to cover that as we do every month on our Wook Book Club on the last Tuesday of the month at 8 p.m. So I created the space. Han, if you could pin for me some of these to some of the upcoming spaces to the nest here, would appreciate it, as well as the thread from this week's Wook in Review for anyone who, again, if you want to kind of see the newsletter and you're not subscribed and you don't get it in your inbox, you can click the little newspaper icon in the Wook Capital profile, and that'll bring you to all of the previous newsletters. You can just pull it up handily so you can kind of see what we're going through. So we noted that we had unveiled our first Wookie watch list. We are still working on a viewable Google Sheet type document that people can easily access and kind of just track what's going on with these different companies. Again, these are not companies that we made a decision that they're good, bad, or indifferent investments. It has nothing to do with any sort of investment recommendation. It was purely, we got feedback from Wookiees over the course of the year on which companies they'd like to see us do more individual discussion and programming on. So you got companies running the gamut from retail favorites like AMC, Bed Bath, and GameStop to tech favorites like Airbnb, Meta, Nvidia, Pinterest, Tesla, of course, and some others in there. So we'll be hosting some bull versus bear series on these securities in the coming future, and also kind of as we get earnings on them, we'll cover them in the Wook in Review. So we've got Dole reported earnings this week, so kind of a little backstory on Dole. This is not the same Dole of yesteryear. There was a prior iteration of this company run by not Rupert Murdoch. I'm forgetting his first name. His last name was Murdoch, but a nefarious character of sorts who's no longer involved in the management of the company. It's actually, this version of Dole is the merged Total Produce, which is a European distributor, and Dole Food Corp. So they kept the Dole name. It's Dole PLC, and it was the merger and then subsequent IPO of the two entities. They'd actually had multiple years. They'd had 3 or so years of strategic relationship with partial ownership before the full merger completed in 2021. They IPO'd in 2021, the same week that Robinhood did. It was a failed IPO. The stock price still trades at a discount to that IPO price. And yeah, so a few updates on Dole. They reported earnings this week, and they are the world's largest produce company, fresh produce. So this is just the fresh produce side of the business. This is not the packaged foods business. That's owned by Itochu. They sold that off several years ago. So Dole, we're talking about bananas, pineapples, grapes, all your fresh fruit and veggies. Albeit Dole did announce the sale of its fresh vegetables business a few weeks back. So they sold that business January 31st. They announced the sale for a bit less than $300 million in cash. They're going to use that cash to delever the business further. The results for the year, which they reported on the 7th, were okay. It's been tough for that business, right? You had a lot of headwinds from costs, from fertilizer costs going haywire, transportation costs going through the moon, cardboard, paperboard, right, to transport all the produce had gone bonkers during the e-commerce boom. So they faced a whole lot of cost headwinds. And while they talked about being able to take price, some of their contracts are multi-year in nature, and they weren't able to take all of the price. So they kind of got squeezed a bit on the cost side. Their revenue was up year over year, yeah, but their adjusted EBITDA, which there's a lot of noise in that adjusted figure. They had a listeria outbreak at the fresh vegetables business, the one that's being sold. So they had tens of millions in loss that it's adjusted out, but it's a real loss, right? So they faced that. They obviously faced a big headwind from the U.S. dollar's appreciation, given that their business is heavily oriented toward Europe. They're geographically fairly split between the U.S. and Europe, but that headwind, it was a currency translation impact of over $100 million. We're talking about a business whose entire revenue for the year was 2.3 billion. So, pretty meaningful foreign currency headwind, right? That doesn't continue to infinity. So, they did present the financials on a like-for-like basis. It doesn't look as bad. I've noted in the past, I had published on my own behalf to Wall Street Bets this Dole idea in September of 2021, and unfortunately, the stock's still down 20+% from there. So it's been beaten up. It has, I think, some interesting assets. It's trades at a meaningful discount to all of the other public produce players. Well, that's a mouthful. But I think until they can really kind of get some of these costs normalized behind them, whatever you want to call it, and show some improving results and the benefits of the synergies that they had forecast when they'd come public, they'll probably continue to trade at a discount. And we'll see what happens with them. They did report a beat on adjusted diluted EPS by a few cents, which doesn't sound like much, but when I think that the consensus was called for 4 or 5 cents and they reported 9 cents, it is a big beat. The interesting thing was yesterday on the entire Wookie watch list, Dole was the only green ticker. Dole was green in a sea of red yesterday. Today, not so resilient in lieu of most everything closing down on the day. It closed down a little more than the indices, but so that's where things are at with Dole. And the forward PE is still, again, pretty cheap at a 12.5 forward PE. The forward EV to EBIT is something like 7 and change. If you pro forma out the fresh vegetables business, it's even in with a 6 handle, and the competitors are at like a 9 handle. So there's some opportunity, I think, for multiple expansion over the coming years. It's certainly a business that will be with us, right? It's a staple business. People are going to be eating fruits and vegetables. And the nice thing they noted in the call was that banana pricing, you think about banana as kind of the cheapest, fresh produce you can really get on a per pound basis. They've been able to take price in bananas, which they are the world's largest producer of. So we'll see how 2023 goes. But Greg, I saw you coming up. I don't know if you wanted to comment on Dole or on another item.
No comment on Dole, Rod, but thanks. Nice to hear your update on it. It's interesting to see some of what's going on with SVB. It seems like maybe almost half of all U.S. venture-backed technology and life science companies bank with SVB. So that's huge. Anyway, I don't have that much right now. I am curious to ask you a little bit later, when you're done with your update, a question about selling lottery tickets to bulls.
Okay. Sure. So, yeah, I think that's about it though for Dole. Don't know if anybody had any questions on Dole. I know it's not the most exciting business in the world. I included it in the watch list. We may remove it if we find that nobody is interested in it. But let's pick some different ones sometimes. Chris, how are you?
What do you think about what do you think about the forex risks related to Dole? They do a lot of their business globally, and in the past they've had quite an impact from the pound going down and euro.
Right. I mean, it clearly had a big impact for 2022, and the question becomes, right, that's not something that goes forward into infinity, right? You could on any given year have a headwind or tailwind from it, but I mean, I don't think it is any sort of existential risk to their business. I mean, yeah, if the dollar strengthens further over the balance of 23, yeah, they're going to have some incremental further losses or adjustments from that foreign currency translation. So, that's a risk, but I mean that's no different than like a Philip Morris or anybody else who's reporting in dollars who brings in a meaningful chunk of their revenue outside of dollars. So I don't see that as a huge risk. It's just, I guess, a normal course of business type thing.
Fair enough.
One other thing, just again for kind of how it ties into the global economy, they do have the world's largest refrigerated container fleet, and they noted that in 22 they had really strong commercial cargo revenues, booking out excess space and capacity on their owned and operated fleet because they are a vertically integrated player. They obviously expect that to come down in light of how meaningfully shipping rates have come down over the last year. So now for the outlook for 23, it's right. It's like that was a tailwind. Now does it become a headwind as you lap? But then you have so many different moving parts. So I think the one thing that, and this is not just them, but I think probably holds true for a lot of businesses, is how uncertain they were about the outlook. And they I think shot pretty low with their EBITDA guide. They guided for like 350 for the full year, which analysts had estimated closer to 400. And I saw after the report came out that they all, of course, marked down their estimates based on what management had to say. But then when you listen to the transcript, or when you listen to the call, look at the transcript, whatever, you can kind of get the sense from management that they just don't have a lot of certainty, so they'd rather aim low. And I think a lot of companies are thinking they're aiming low. So it remains to be seen how the year pans out. But these are people who've run the total produce business for decades. It's not like it's their first rodeo. They, I think, ran the business during the Great Financial Crisis. So they've been through tough times. I think that they know how to handle themselves, and it makes sense that they're delevering with the sale of the fresh vegetables business to make sure that they don't find themselves in a tight spot with their relatively high leverage. I think they're down to I guess we have to conclude the sale of fresh vegetables, but it's going to have a 2 handle. They're going to stay under that 3 mark, but yeah. So, okay, that's probably enough Dole for one day. Okay, so I got 2 topics left to go through, and then we can get to kind of more open questions, or go back to the SVB that we already talked about. We can kind of circle back to that because, again, it's clearly top of some folks' mind. So I gathered a few articles on AI. I kind of posted a thread, about AI. I made some comments, that it seems like the consensus is that, unlike crypto or Web3 just being buzzwords, yeah, AI is a buzzword, and clearly, as you can see from the graphic I lifted from Bloomberg, showing the frequency of mentions of AI by quarter, right? It's not like it's a brand new thing. People have been talking about AI for a while, but it really ramped in this first quarter with the whole Chat GPT investment from Microsoft, and their plan to attack Google and search. So I guess what I would highlight, and again, I'd really love for folks who maybe have done work on AI to chime in, or who know the space, to share what they're hearing and seeing. I commented, and I lifted, from Satya Nadella at Microsoft. He said, quote, "The entire search category is now going through a sea change. That opportunity comes very few times." So if you remember, Howard Marks used the term sea change in his memo late last year about the rate environment. Satya is talking about the search environment, going through one of these profound, once, every decade or 2 or 3 or however many sea changes. So it's not just search. Obviously, for Microsoft, that's a primary vector, but the stories I linked in the newsletter, which I used the archive.ph tool. So if you don't have a Bloomberg sub, you can see them, but it's running the gamut of advertising, search, translation, companies using it for customer service, for inventory analysis and procurement. So there's definitely a lot of different examples that were shared in there and that I've heard about. And my question would be broadly, what are the opportunities for AI that aren't already priced in to some of these stocks, right? Obviously, NVIDIA, from the graphical process, the GPUs that go into supporting the build for these language learning models and other models, requires these GPUs in mass. There was one interesting read this week I saw about how much energy these AI programs consume, and it was interesting. NVIDIA made some comments about being more efficient than CPUs, but the absolute level of consumption isn't really being disclosed. So you get these. If you think about Bitcoin, right? It's Bitcoin consumes as much energy as Argentina, right? Is that a good or a bad thing? Obviously, AI is going to lead to increased energy consumption. There's been different analyses talking about for a Microsoft Bing, what is it? It costs them many multiples more to process a search query using AI than just a search query as done today. So there are elevated costs for AI. There's elevated energy usage, but it's how much productivity are you adding? And I mentioned this in I think the open mic call, that I'd seen a couple of research reports noting that for knowledge workers, they're seeing some meaningful increases in productivity. And granted, it's still early, and these are still largely generative AI, whether it's text or graphic output, that whether it spurs the human to think creatively, or helps them get a head start on doing something. Clearly, everything I've seen so far implies there's a meaningful uptick in human productivity, which is great. So yeah, and I'll open it up if anyone wants to talk about AI a little bit. Anything they've seen that either aligns with that, or in addition to that. Yeah.
Hey, Rod. So just in terms of, you spoke about knowledge workers who are seeing meaningful upticks in productivity. One organization that I'm involved with is the CIC Angels, where I'm a managing partner in one of our portfolio companies. Again, this is very early stage startups. Has built they're called Clear Cogs. They build a predictive PARS, so product amount required tool, for basically inventory management and cost management and demand forecasting for restaurants. And they're seeing restaurateurs and chefs getting a tremendous amount out of their integration with ChatGPT, just being able to directly query about any particular ingredient that they need to be ordering and when they're going to run out, and how much a certain Jimmy John's ought to defrost in terms of the French rolls that they need to pull out. And so I would just call out that it's not just knowledge workers. It's like people who are in these very timeless industries like the restaurant and food and beverage business, will also be able to unlock productivity through these types of technologies. And I think it's just kind of far out before we see some of this productivity and some of this value hit public markets. But it's coming.
Well, thank you for that, Greg. I'm a tech, and I always say this, I'm a tech Luddite, so I'm not well connected to this stuff. So thank you for sharing what you're seeing and hearing kind of from folks, live. And yeah, that makes sense that a lot of this stuff is still so nascent that it's hard to maybe locate where in public markets you could find that it's not yet priced in. So no, that's interesting. I mean, it does. I think it's like pretty universal that this is a real thing, and the results are real, and no one knows precisely where I guess the full penetration of it can get to, or where we go to with this new regime. But I mean, it's nice, right? Because there's been a lot of worthless or useless type tech that's come out, funded by venture capital dollars, and I'm glad to see, hopefully, this sort of technology that can really profoundly, improve productivity and lead to economic growth, right? Because with huge productivity gains, even if you have the same number of workers, of course, the simple math is that would be fantastic for the economy.
Absolutely. Yeah. So I think we'll see that, specifically the data management space, and anybody who is working with complex data and finding business intelligence within it is going to be able to unlock intelligence faster through this new interfacing ability that is either coming through text or through voice. There was a lot of buzz around this kind of thing with Alexa integrations for kind of smart home companies not too long ago, a few years ago. And what we're seeing now is just that these generative models are able to unlock insight that really are surprising connections. There is one Wharton professor who I'm just going to dig up his name really quickly to share with you all, who is writing about this really well, and has really used ChatGPT within his classes.
I think I know who you're talking about. I can't think of his name right now either.
Yeah, Ethan Mollick.
That's
so
it.
He has this one useful thing Substack, and he does really good analysis, data driven, on how these new technologies are directly impacting his students, but also how he thinks that extends into industry. And I think because this is so nascent, it's important to see how students at Wharton are using these technologies, because those are going to be business leaders in just a few years.
Awesome. Really appreciate the commentary, Greg. Thank you for your insights. Is anyone? I had read one of Ethan's write-ups on that Substack, kind of talking about his students kind of really pushing them to use it. And I think you're right. It's one of those things you need to start playing around with. I had not even used it until a week or two ago. The DALL-E, just the image generation model, which is obviously a different one, but just super neat. I mean, like you said, it's so nascent and early. We don't know what it's going to lead to, but it's really awesome, the breadth of spaces in which it seems like productivity gains are going to be achieved through this technology. And obviously, then the pessimists in the room are going to point out, well, if people can be a hell of a lot more productive, then you're probably going to need fewer people to get these things done. So is there eventually a labor impact? And I think that those are fair things to debate. I don't know I want to have that debate right this second and sidetrack us, but just kind of a thought that, of course, I think people will voice a concern. So, okay, it's 4:45. Let me get through the last topic here, and then we can go kind of back to open, freewheeling, address any of the topics. And the last one here is I gathered some of the economic data. So just to kind of talk about like where's the job market at? Obviously, the report this morning came in hot in that the headline number was a big beat versus what was expected. It was 311,000 versus the 230 or whatever 10 it was supposed to be. The wage growth cooled a little bit versus forecast, so that's good. A couple little interesting things that I saw. For one, truck transportation saw the third largest job decline in the last decade. So I've mentioned a couple times in preceding weeks that the top is in from a transport. I had thought that the top was in, and clearly the top is seeming like it's in from a truck transportation perspective. I've made this point because it's an industry I follow closely and have some insight into, that a lot of people entered that industry in the boom times of late 2020 through 2021, really into the beginning of last year. A lot of people probably bought equipment at elevated prices, and unfortunately, though freight prices have come down meaningfully since then, and now we're seeing a meaningful exit of labor from the transportation side of the economy. So the goods-oriented side of the economy, right, still giving back some of those jobs, whereas then you see the strength is in continues to be in how strong leisure and hospitality are, which there's still fewer leisure and hospitality jobs by about 400,000 workers than there were before COVID. So as people continue to spend more on services, going out to eat, the like, you see it everywhere. Anecdotally, it seems, at least most places, that there's still a lot more demand than there is supply of those workers. At an aggregate level, the math seems to vet that. But we got, I think, a data point that was strong, but moving in the direction the Fed would like to see, maybe not at a fast enough pace. And you got also, right, a few other things this week. So the job openings report came out earlier in the week, the official JOLTS data, which is a lagged figure. So it was January job openings. And during the open mic on Wednesday, I think we talked about the fact that from Indeed and from LinkedIn, who also, of course, Indeed has a lot of that data, and LinkedIn as well, they may skew maybe more toward white collar worker or technology worker, but those kind of more live data points from listings and openings are also coming in. So it's like these things are moving in the direction the Fed would like to see. Are they moving at a fast enough pace? Probably not. Though, does the Fed, pressing the pedal on the restrictive accelerator, break things before? Because clearly, right, this big bank failure today, that something broke. Whether it's purely the Fed's fault, I would argue it was again that company's poor management of their duration risk in their portfolio rather than the Fed's fault. I mean, it's not like the Fed came out of the blue, and it's not like other banks have, knock on wood, met the same fate. So, I would say all in all, like with the economic data, you had the blowout print, right, that happened last month. So this is off of that. It's still high. You're starting to see jobless claims tick up. The initial jobless claims ticked up to a 2-month high. Continuing claims rose the most since November 2021. So the labor market, of course, does seem to still be too hot. It's cooling. The question is the rate of that cooling, to measure it with the Fed's desired inflation numbers, not so much. So, we'll see where things go from there. There was one other story that I wanted to highlight in kind of this vein, which was really timely because we talked about it on Wednesday in our open mic. The idea that even though input costs are declining for companies, they are still raising prices. So it was fitting then that yesterday, Odd Lots published this story with the headline, how excuseflation is what they're calling it, is keeping prices and corporate profits high. And essentially, this is where basically using the cover of all of the ongoing disruption and headline around these issues that suppliers and the like are facing, that they are opting to continue to take price using this, under the auspices of this excuseflation, despite their input costs dropping. And that was in line with, he's a private account, so unfortunately I can't, I can, if you're following my screen, actually, I can go to Prep Remarks. So he's at Prep Remarks. He's got like 13K followers, but he locked his account. But he had a thread that was pretty much in line with this. He noted he's a CFO for several small businesses, and that this is kind of what they are seeing is they're getting a lot of requests for price increase, and then he'll push back and be like, I know that your input price for X commodity is down Y%, and many, I guess, of the maybe less sophisticated small businesses presumably aren't pushing back on this. And of course, consumers at the end point to date haven't really been pushing back on this. So, they're kind of continuing to use this excuseflation to increase prices, which obviously if input costs are down and prices are up, that's a boon for margins. So it remains to be seen how this all pans out, because the Federal Reserve certainly isn't going to be happy if that's what's happening through the economy, that corporations are taking price despite costs dropping and not passing along that disinflation or deflation to consumers. But I thought that was an interesting read. I don't know if anyone had read it or has come across that in any of their day-to-day or in their business workings, but it doesn't seem like a one-off. I'm seeing multiple anecdotes of this, and then kind of seeing these people that cover the industry and these industries noting this. Companies aren't afraid to take price, and clearly they haven't gotten a lot of pushback from maybe unsophisticated buyers yet. But I guess when or whether that pushback appears, maybe the magic words. I don't know. Greg, I see yourself here. I don't know if you guys are seeing any of this or have any comments on it before we kind of wrap the prepared segment and open things up.
Rod, I'm happy to help you open things up. I have a question,
right,
if you want to. Yeah, so I listened to an interview that you did with Benzinga at the end of January, and this is what I was referencing earlier about selling lottery tickets to bulls. You spoke about this idea of being opportunistic, selling naked calls, and you even mentioned possibly there's an opportunity to do that with Ulta. So I wanted to understand that and just dig in. When you have a company that is, yes, Ulta.
I don't remember mentioning
ULTA.
Ulta, but
okay. So
but I know what you're talking about.
Yeah. Let's leave that particular example out of it. If you have a company that is both profitable and growing, so that shares those characteristics that are generally very favorable, but you happen to think maybe the valuation is still too juicy. So instead of going with the Ulta example, we could go with some of these generative AI opportunities. Maybe there's more buzz than actually should be priced in, right? You brought up reasons that it may not actually have as positive of an outcome, even if there is growth and productivity. If you see that being the case, where would you decide that there is a threshold on the valuation? How would you quantify the valuation being too high in the face of a company that is both profitable and growing? And if so, if you were able to do that and choose to sell these naked calls, then how far out of the money would you want to do that, and how would you quantify that?
So I would emphasize when I say opportunistic that obviously the word is defined as it is. I definitely mean that in not doing this on a do it all the time, right? You would do this if the market is begging for liquidity, right? If the market opts to price the volatility at extraordinary levels. This has happened a few times in Bed Bath Beyond, right? In the preceding few months, it it's basically, whether you call it a short squeeze or gamma squeeze, whatever it is, the price has done this wonky thing. Let me look at the 1-year chart, right? So I'm thinking about a couple of instances with Bed Bath, right? In August of 2022, the stock ran all the way up to like 30. It peaked at $30 per share, but I remember the implied volatility for Bed Bath during that, and I know Chris R., I know you're listening and you are familiar with Bed Bath, so if you want to chime in at all, feel free to come back up and do so. But like the implied volatility got over like 600-700%, annualized IV. So like in a situation like that, you could write 50% out of the money. And look, I would say that's what I'm saying when I say opportunistic. I'm not looking at somebody like Ulta on an ongoing basis to write a naked call as an attractive risk reward. This is for sophisticated players. This would be someone who has a very hefty balance sheet that can support the risk of those lottery tickets having to be paid out, so to speak, by a rapid price move. So I'll talk through the Bed Bath example with our situation there. Right there, it was August 8th. It was Monday. The stock was added to Wall Street Bets that weekend. It was extraordinary volume of commentary on Wall Street Bets. The stock gapped up. Volatility went up multiples that morning. So that day, it was very attractive to write, I think, some out of the money calls, shortish dated, and even though the price ended up going up, 2.5x from there before, basically everyone and their mother who was institutionally long the stock sold, including Ryan Cohen, seemed to end the short squeeze. I thought the risk reward was pretty attractive. So like in that example, right, it's clearly it's trading like a token. It's wholly disconnected from underlying fundamentals, which of course since then it's continued deteriorating. It's staved off bankruptcy for now. But when I talk about opportunistic call writing, and that's just one example, it would be tickers where the volatility goes to ungodly levels. A willingness to potentially absorb some pain. I know Chris R. And I had talked a lot about Revlon, which was another one before they turned options to position close only, where the volatility went haywire. There was orchestrated gangs of squeezers out there trying to pump the stock, despite it being either in or on the cusp of bankruptcy from all the reporting. So that's what I'm talking about when I'm talking about being opportunistic is looking for these low quality companies that see their price appreciate meaningfully for no reason. There's obviously risk, and there's a lot of risk, right? Because if people were to think about GameStop in that kind of context and think, oh yeah, in January 21 it ran up to 40, 50, $60. Oh man, that's crazy for GameStop, and then they obviously got blown out. That would be the worst possible scenario for this sort of an activity. So I know it's not precisely kind of what you were asking, but I think that's more so what we think about when we're talking about like opportunistic lottery ticket writing. If that makes sense.
That makes a ton of sense. Yeah, no, thank you for laying that out. I certainly understand the reason to consider this type of a move in the context of tremendous volatility that maybe doesn't have, the actual substance behind it. I was surprised on that particular YouTube recording just because it sounded like you were talking about a company that was profitable and growing and maybe still has too high of a valuation, right? And so
let me be very honest to make sure that no one's confused. I personally have puts on Ulta. I have January 24 in my personal account, $420 strike puts, because I would agree with your sentiment that Ulta is and has been a fantastic business, but it's kind of like just like there's a price for any business, like with Costco, and so Wook is unassociated with this, right? This is just my personal account, me talking about Ulta. But I would not think of Ulta as an attractive candidate, for the naked call writing necessarily. I mean, you could probably generate some income, but I don't think that the risk reward is that attractive there. But I would argue with Ulta, I mean, they're facing obviously a lot of fundamental competition coming out with the Kohl's installation of Sephora's in all their stores. There's a very heavy footprint overlap between Kohl's and Kohl's and Ulta. So like I also look at Ulta gross margin. I mean, they took gross margin up big time during post-COVID era. I don't know that it's going to be that structurally profitable. I think that they talked about this week in earnings like a 14-15% EBIT target. So it's like I think that they're going to be challenged on growth. I think that it's priced too richly relative to what I think is going to be a deceleration in that rate of growth. So like that's my personal thesis. So I don't remember in the Benzinga what I said about Ulta, but that's my current sentiment on Ulta. So it's not connected with the lotto ticket writing, but just that's my personal thinking about Ulta. I think it's overvalued. It obviously had a very solid earnings yesterday, and I'm not happy that it held up the way that it did. But I do believe in the coming months, as the consumer kind of keeps, being a little challenged. I think that a lot of the beauty spend might be maybe they front loaded some of that. Obviously, Elf Beauty I saw was down big yesterday. I didn't see it today. It was down a little bit. So like I know there's a little bit of a mix shift within that beauty industry. But yeah, that's just some thinking on Ulta.
Really interesting. Yeah, thank you for sharing that.
Yeah, absolutely. And speaking of Bed Bath & Beyond, I saw that it actually closed up almost 10% today. So that's wonderful for them. They reported yesterday during the day, they filed the 8K that they had gotten another tranche of capital through their very complicated securities sale to purportedly Hudson Bay Capital. So for now, Bed Bath is still alive and kicking. That rally helps it to avoid a price failure, which I believe it is like the low point of the 20-day VWAP. If there's an average below $1.25, it basically nips the whole scheme in the bud. So whether this was Hudson Bay or someone else trying to move the price up, right? Who knows? I mean, I know that there's a very rabid retail interest. Some people speculate that there's going to be some form of M&A with Ryan Cohen and Carl Icahn. I do not put any credence into those speculations personally, but it is nonetheless curious to follow along with. And it is on the Wookie watch list for that reason, because a lot of retail folks are interested in it. So we continue to follow it. Chris, I don't know, did you hear or see anything about why the price did what it did this afternoon?
I don't really have any indication. I mean, it pretty much is a penny stock, so I don't really know if it really needs a reason.
Did the bonds rally with the equity today?
The bonds are down a little bit with this whole news, but I saw this. Somebody referenced this comment on Reddit. It says, when a bank worth tens of billions can disintegrate like a shit coin, it seems like you're rolling the dice no matter what you do. May as well make the value play. So this is referring to Bed Bath & Beyond.
As the value play?
The state of Reddit.
Got it.
It's Bed Bath & Beyond is the value play, guys. That's what Reddit is saying about Bed Bath & Beyond. So that's the kind of sentiment I guess you're seeing with this thing. So I guess, yeah, that's just the kind of, the feeling that people have that, if a bank can go bust, then might as well just invest in this company that doesn't make money. I don't know. It's weird.
Yeah, that is. Hey, I saw that our friend Mr. Sick One, you're up. Hey, I hope you're doing all right. I know that the job situation has been a challenge. Hope everything's going well, buddy.
Yeah, I mean, like it could definitely be worse, but I kind of expected it like back in November. Literally like when whatchamacallit, like after their earnings came out, I was like, all right, some shit's gonna go down. And then like a couple months after that, like if everybody's familiar with the whole Disney situation, Chapek got booted out, and then all of a sudden, like Iger came back in. Like I was literally watching TV, then all of a sudden, like I got an email like with Bob Iger in the header. I'm like, what the hell? Read through it, and like finding out that he came back. Then right after that, there was like a gigantic hiring freeze over at Disney, and then, as you guys heard, 7,000 people are being let go, contractors first, and now recruiters are being hit first. But actually, I went to a networking thing yesterday over at Netflix, and something I've noticed both at the studio level, both for Disney and Netflix. I'm wondering if anybody can give me some insight on this. They're hiring more accountants, like content accountants. Like they're literally looking for people from one of like the big four, like either KPMG, PwC, EY, or Deloitte or whatnot. Does anyone have any insights on this, just out of curiosity?
Disney hiring a lot of content-oriented accountants. I hadn't heard anything about that.
Or this was specifically Netflix,
Oh, Netflix,
or like
sorry.
the event that I went to yesterday. Yeah, but also I know that Disney's also doing more auditing work or like content work, accounting work on their end also. I'm not sure whether like the studios are trying, like the tech companies are looking for where their dollars are. I don't know if that's something to like look into, but I'm wondering if you have any insights on this, like after massive layoffs or like hiring freezes, companies hiring these like accountants or like money counters, or
Not me. If anyone else on the speaker panel or in the audience, does, please, love to hear it.
I guess not.
Crickets. Okay, but just to kind of recalibrate for everyone, we finished the prepared content that I walked through on this week's Wook and Review newsletter. If anybody kind of wants to talk more about the situation with the failure or with SVB entering receivership, I mean, Greg, I'll be quite honest, because as I mentioned earlier, I'm a technology Luddite. I had never heard of the bank in my life until a week ago. So somebody mentioned it early in the week, and I said, SVB, what's that? So it is certainly, for maybe those who aren't connected to the industry, a big deal, as you pointed out earlier. And maybe you can kind of recap that it's a very major player for a lot of the venture companies and startups kind of in the Valley. For those of us who are foreign to that world, I didn't realize how integral it was, to be quite honest.
Sure. Yeah. So, I mean, it really has been just an institution for the biotech and tech worlds. I think Fierce Biotech was the source where I got that figure of nearly half of all U.S. venture-backed technology and life science companies banking with SVB. They put that out just today. It's worth recognizing that as far as private companies go, it's early stage and late stage companies that are getting hit. The early stage ones may be in an okay position where, if they have been able to secure enough of their funds so that the actual cash in SVB is under that $250,000 limit, they're going to end up getting that money back from FDIC. But that's only for companies that don't have that much money and that are just super early stage. For some later stage companies that have raised big rounds to be able to weather this potential downturn that people have been talking about for quite some time, that we haven't really seen happen in full force as much as many predictions have kind of called for. If a lot of those assets were held in cash in SVB, it can be just entirely devastating. And one of the bigger impacts that's kind of systemic is that there are some companies that had like, they're not just the companies that themselves are paying payroll out, they are startups, but rather payroll companies who, on behalf of other companies, are holding cash. Some of those may have had their funds with SVB, and so that will affect the payroll of a broader pool of potential startups. Um, I don't have an exact example of a company doing that, but someone mentioned that to me earlier today at lunch. Um, and so I think there's really like an entangled set of issues here that's going to be hard to fully understand for quite some time. But it's, it may very well be a situation um, where this is the tip of an iceberg and there's a lot more underneath the water.
It's going to be an interesting weekend. I'm sure there will be reporting throughout the weekend if someone, whether it's a Warren Buffett deciding that he can get some sort of attractively structured deal to step in. Obviously, I heard Bloomberg talking about Chase as the likeliest of the big banks. So the reality is, if you own equity, if you own stock in the company, you're probably SOL. But there's definitely question marks for those businesses who have all their payroll flowing through SVB, and they have above the FDIC insurance limit. Will they get their money back? And I mean, it's uncertain, no matter how you slice it at this point in time. I would argue it wouldn't be encouraging moral hazard. Well, nearly knocked over my coffee. It wouldn't be encouraging moral hazard. It's not as though this bank seemed that people were going into a Wild West, taking this copious risk. I mean, clearly the bank itself poorly managed its duration risk, and that kind of led to this. But for the depositors, whether the government makes them whole in some capacity, I mean, who knows how it's going to play out? But it doesn't seem like that would be good for a huge swathe of tech and biotech companies to be out in with a huge fog of uncertainty hanging over a portion of their their assets, of their deposits for a long time. I've got to think that would, if that were to happen, then this sort of thing could become more systemic and potentially spread into areas that who knows. But I'm speculating here. I have no unique insight. I'm just going by what I've read. As I mentioned, I had not known of the bank until just this week. So, yeah.
Rod, I would just add one thing on your comment about the bank itself not taking the risks that the bank itself took. So I'm currently doing a master's of science in computer science focused on AI, and I'm prototyping a tool that'll be useful within the biotech space. And just from having simply like the CEO of like an early stage venture on my LinkedIn, like it was just a month and a half ago, I got outreach from an SVB associate, who was asking how he could support me. It's really unusual to get that kind of outreach, from the 16th largest bank in the U.S. When really this is like something that emerged from a class project that I haven't even gone to try to like seek any funding for or do really anything for. I haven't advertised it. There's no website up. It's interesting.
That they found you, yeah.
That they still
You're right.
found
You wouldn't
that
expect
they have
JP Morgan
people,
Chase size bank to find a little old Greg. No.
Yeah. So I guess the it's an anecdote. That's not real data in any like meaningful way, but it's
That's
just
interesting.
It's surprising that that you see this kind of behavior. There's certainly like the asset management issue, but then there's also the question of how were the people at SVB spending their time, and the other question of just like which types of ventures were they supporting, and so maybe maybe it's not just a problem where a couple of big, VCs had said to their portfolio companies that they noticed some of this problem around the bonds you were referencing earlier depreciating in value, and saying, hey, you ought to get your funds out of this bank. And then those companies all doing that and causing a bit of a run on the bank, and the bank running out of funds, and then trying to sell
that's
stock
another
at
part
a
of
loss.
this conversation that's interesting, right? Because like if you didn't have, I think, a tranche of that VC community, like almost, I don't want to say they were encouraging a bank run. I mean, I totally understand. Once that cat is out of the bag, it's kind of like you got to act in your own best interest, and the lowest risk thing to do is probably to pull your money. But it almost seemed like, from my loose observation of what happened, that whether the goal was this end result or not, that the folks who kind of almost called on the bank run, it will be interesting as this as this post-mortem plays out, to understand some of the ins and outs better. But it's incredible. Maybe it speaks to also, just in this world of information flowing at the speed of light, yes, we had this, sure, 15 years ago in '08, but if things like this are apt to happen, can they be organized more than they maybe could have been in the past? Obviously, like somebody in the Valley with a big megaphone, like a Peter Thiel, can say, pull your money out, and people maybe are more apt to listen to him. But I don't know, it just raises some interesting questions in this very social and connected world we have of a bank simply relies on trust, right? It's an entity that is a commodity. I mean, to your point, there's obviously a different caliber of service perhaps a specialist can deliver, but on net, it's a money supplier, a money changer, whatever. It's a bank. It's one bank. They're all the same. And I say that as somebody who worked at Bank of America for many years and was proud of my time there, right? It's not like it's delivering some really impressive highly engineered technology. Well, which again isn't to say, I mean, these big banks actually have a huge amount of technologists and chief technology officers, like, and tons of patents actually on a yearly basis. So let me not belittle the banks. I don't mean to do that. But more so what I mean is that, yeah, I'm just curious to see if in this new world of always on information getting around so quickly, will we see more of these like flash bank runs? I don't know. One other point, I know I made it earlier, but they didn't have a chief risk officer for 8 months. They appointed someone in January. So for most of 22, while the Fed, was going through this rapid tightening cycle, this bank had no chief risk officer. I see that it was cited that they did hold meetings of their committee, their risk committee, I guess, but how much of an impact did them not having a dedicated professional overseeing that during kind of this time of rapid rate hikes? How much of what went wrong is a byproduct of that? Again, I don't know the answers to these things. I'm very curious. I'm sure we're going to get a lot more reporting over the course of the weekend. But yeah, I don't know if anyone has any thoughts. Like, am I off base in thinking that like socially generated bank runs are perhaps a risk that until this week maybe are greater than we would have thought previously?
I think it would be, really hard for anyone except for people like Peter Thiel to generate that kind of effect. And I think you really would need to you'd need to have a megaphone that doesn't just hit a massive number of, individuals, but rather hits a large number of companies that have raised Series A's, B's, C's, and have many millions of dollars to pull out. I recently spoke with one founder in a portfolio company who had raised a $17 million Series A just not that long ago. And boy, were we thrilled that they did get their money out in time. And so I feel like there's just this question of, who can speak to people in that position and get them all to act at once. I don't know that this is really a risk that we could forecast
more of a one-off,
happening again.
you think? Yeah.
Yeah, that would be my hunch.
I think you're right, though. You need to have the right circumstances, and there's only so many people. If Elon Musk tweets out that everyone should remove their deposits from whomever, right? That there's very few people that have that sort of reach that could really effectuate maybe that sort of a rapid shift in thinking by an individual who's widely read and maybe respected.
Or as you were saying earlier, maybe if Jim Cramer were to tell us all to leave our money with a specific bank, that might do it.
Hey, J.P. Morgan is a fortress. Nothing can ever go wrong. Cramer has decreed it. I mean, just it's incredible that he called SVB one of his best recommendations just several weeks ago. I mean, it's uncanny how effective the inverse Cramer has performed. And for those who are unaware, there's now actually a product in the market if you want to invest in the inverse Cramer ETF. So if you want to go against Jimmy Chill, you can do so.
I got a question about that. Like, who's running the inverse Kramer fund? By the way, like I know I thought I saw it like on what was it, like Unusual Whale. I wasn't too sure whether they were running it or not.
Tuttle Capital, I think, is the one, and they've done a few of these like creative ETFs. Yeah, so they're the ones who filed the prospectuses. I actually don't even know if they're yeah, they are. It is live. There's Long Jim, LJIM, and SJIM.
Hey, also, I got another question about like the whole SVB, the Silicon Valley Bank thing right now. Sonali Basak from CNBC just posted that Roku had 25% of their. Oh, Bloomberg, yeah. Roku had 25% of their money in SVB, and that's actually probably going to affect my industry a little bit. And I know that whatchamacallit, like over at Disney, when they started the Disney streaming side or whatnot, for all intents and purposes, like Disney's like 6 or 7 different companies in like one, and they all had their own. Either their HR system was split up, or even I think their banking and accounting systems were also kind of split up for a minute. So I'm kind of curious, like if SVB held any other, or like where to look into that information.
So Greg, I think made the point, right, that Series A being able to pull out the capital, obviously great for them that they were able to do so in time. If companies like Roku and others. So I'm going to read from Matt Stoller at the American Economic Liberties Project, basically kind of commenting on this right now. That in his view, the uninsured depositors are going to take a loss. So, I mean, all else equal, right? The folks who have more on deposit than the insurance coverage are sophisticated, are considered pretty sophisticated players, right? Whether they are or aren't. So how much of a haircut is Roku going to take on that cash portion? We just don't know at this point in time. People are speculating that there will be haircuts. People are speculating that there will be a bailout of some sort. I mean, it's just still up in the air. And as far as I know, there's nothing set in stone. It's the FDIC is going to try to sell it off over this weekend to somebody, and if not, it's going to be liquidated. And as I mentioned, like 90% of the depositors there were uninsured. So uninsured meaning they had more on deposit than the insurance threshold. So I mean, it's going to definitely be interesting to see, right? If it is going to impact some technology companies who had all or some of their business with them, if they're going to have to realize a loss, and will that loss be enough to for some of them push them into insolvency or a need to raise incremental capital or whatever? I mean, it's definitely a huge question mark. What will the ripple effects be? And I think that's why the market traded the way that it did once the news came out late in the morning that FDIC was going to put it into receivership. It was the market had gone green, and then I think really since that news came out at like 11 whatever, it was mostly downhill from there, and volatility really skyrocketed because markets don't like uncertainty, and this is inherently a very uncertain event. Chris, you got your hand up. You want to chime in?
Yeah, I was just going to ask, do you think that given the state of inflation over the past few years that the FDIC is going to have to
bump the
increase
limit? That's a really good point.
Yeah.
I don't, off the top of my head, know how the law is enshrined. That's a really great point, though, about how many of these limits that exist, whether it's an insurance coverage or a contribution limit for 401k, whatever, like how many of these are not pegged to CPI? Minimum wage, right? Minimum wage, in real terms goes lower every year because it's not pegged. So I don't know for FDIC if that's a congressional act that it has to go through, or if there's just an agency change. I'm going to guess it's Congress. But it's a great point, right? It's been 250,000 for how long now? And that 250K doesn't go as far as it used to.
Yeah, and it really would change people's behavior, right? If there were to be a situation like this, if it was maybe 500,000, right? Or like 350 million, maybe they wouldn't take out so much money and cause such a big bank run so quickly.
So one thing that'll be interesting with this isn't like directly continuing what you were saying, but on the same topic, some of these later stage private companies, many of which may have been looking to at some point IPO over the next couple of years, that may have large sums of money that are unrecoverable. They may have to take serious loss, but if they have any sort of a moat, or if they have like a real advantage operationally and in the market, then there's going to be a need for them to raise more capital very quickly. And what's interesting is that from 2000 until like 2015, the dry powder, so like undeployed venture capital money, hovered around 100 billion USD globally. I was seeing this in August in the Wall Street Journal, and then over the last like 8 years, that number grew to over 500 billion. And so there's just a tremendous amount of undeployed capital that might be able to come in to the rescue at this moment in time for later stage companies that then may make their way to public markets still within the timeframes they were hoping. But this could actually be the reset that may be required for them to actually take a haircut, get to a valuation that actually puts them in a place where they can then go and get an up round when they IPO.
It's really interesting, because I'm sure most folks who are listening have kind of been following along with how a lot of the private marked assets have not been marked down. So it's almost like, Greg, will you have a good excuse if you were an impacted entity to go out and say, look, we're going to do a down round now because of SVB. It would have been a down round had they had to do it anyway, but it's kind of like maybe they have a good excuse to do that, which isn't to say anything about the promise of that business from a future IPO perspective. But there's clearly still a lot of dry powder all around, whether it's PE, VC, or even in public markets broadly. So yeah, that'll be really interesting to see. If some companies are going to have to do just that. Hey, Syed, go ahead.
I just had a thought right now. As a contagion for SVB. So like Roku and Hulu, like are they're less than a mile from each other in Santa Monica. I know like Hulu is owned by Disney, but like 2/3 of it is owned by Disney. Is there a possibility that this contagion might spread to like the bigger companies that own a big chunk of these tech companies, whether through acquisition or like with SVB like being locked up right now, and then like them not being able to like do payroll? And I don't know like how the banking system works in terms of the smaller startups which got acquired later. If they have like their own bank system on the side, kind of like Hulu, which isn't completely owned by Disney, just 2/3 of it.
It's a good question. I don't know the answer to it. Just to answer the question I think Chris kind of had earlier, though, just so FDIC obviously came about during the Great Depression in 33. Coverage in 34 was $2,500, and then they raised it to $5,000. It's basically been raised. It had been getting raised in like decade type increments. So 1950 it went to 10, 1960. 66, it went to 15,000, 69, 20,000, 74, 40,000, 1980, it went to 100,000. And then, of course, during the crisis is when we got the 250. So it seems like acts of Congress, to go back to how it gets effectuated, and it's definitely not been, it doesn't seem like it's something, I'm sure now, right, with this event happening, it'll probably lead to more debate, and hell, maybe that's some sort of an act of Congress that both sides can agree to. Not that there's much that they can agree to, but FDIC insurance coverage is not pegged to inflation. But in terms of your question about like how it affects all these different entities, I don't know. I don't know if anyone here really knows. And I can say I'm just happy I'm not working in any of those companies' accounting or finance departments, because I'm sure they're going to be very busy, and it's not going to be a fun experience for them, for anyone. Just not a good thing, no matter how you slice it, unless you're a perma bear and you're happy today. The Bears win one.
Yeah, do you think it's been like more like a reactive thing than a proactive thing? Like during the financial crisis, they raised it like in 2008, or when exactly?
Yeah, 2010 legislation made that temporary. It was a 2008 Emergency Economic Stabilization Act was signed in October of 08, which raised it from 1 to 250. And then legislation in 2010 made it 250 permanently. So it's been over a decade since it's been touched.
Yeah, and especially to people living in Silicon Valley, $250,000 really isn't a whole lot of money for those guys.
Yeah, Jiro, hey there. Do you want to chime in on this?
Hi, Rod. Yeah. I joined late, so sorry for that. If I'm if I'm talking about something that you talked about, I'm just thinking about if we look at the market, and we are always waiting for the thing to break, right? The Fed will break something, and actually a couple of things broke already, right? Like if we look spec market first, then the crypto market. And now it's the first bank which is not 100% related to to crypto market, right?
Right.
It's a VC market now. So to me, it's actually very fascinating, because last time I think we talked about stocks, right? And I said that banks look very attractive because the yield curve is so inverted that there's only one direction, I thought, right? And the direction would be that there will be a steepening of the yield curve. Which is in favor of a bank, of course, right? But I think because the market was now expecting a 50 basis point hike, that the yield curve inverted even more, right? And so I think it's not a surprise that also it's not only SVB, that collapsed. I mean, when you look at bank indices, I think they all lost big time today, right? So it's the whole banking sector.
I mean, you've got a lot of the big banks trading at literally levels they were trading at 5+ years ago, and I mean it's been a reality ever since the Great Financial Crisis that many of the banks have just continuously underperformed, and I would have agreed with you that on their face, a lot of the banks probably as a sector looked attractive. But I will say I did put some capital to work in Bank of America this morning. When it was trading at like $29, which just seemed absurd to me. And the only reason I felt comfortable doing that is because I worked there for so many years under Brian Moynihan. I know the enterprise and the culture at BAC. I don't think that they are the egregious risk takers that maybe if you look at the history books and think about them buying Countrywide and the like, that it looks like they are or were. They're not. So for me, I felt comfortable putting some capital work in BAC in my personal account yesterday and today. So far, right, it's okay. It seems like it's stable, but clearly with that uncertainty, the small regional players who maybe don't have the same, they're not so too big to fail. They obviously underperformed relative to the big banks. And yeah, clearly with this fear and uncertainty now out there, I would imagine the banks are going to, even though you would think the fundamentals are in place for them to do all right, with rates having risen, it's like they can't catch a break. They're damned if they do, damned if they don't.
Yeah, I mean, it's interesting that it's not only the stock market, right? It's also the bond market. And
no credit to
and also
your
what's interesting is,
what did you see there today and yesterday?
No, I have to say in general, it's just very interesting that because now we actually
with the rate,
think about the
we
business
talked about
model
this
of a
at the
bank
onset,
again, right? Sorry?
Right, how the pricing is shifted away from 50 and back toward 25 seems. I mean, I think it would be crazy for them to do 50 after this week's events, unless there was some obscene inflation print, at which point then I could only see it with something like that. But I mean, I could even see it pause, even though it's not priced, right? If the inflation print were weak, I could see them saying, listen, while we still expect that the ultimate terminal rate will be higher, we understand the long and lagged effects of our policy decisions, and we are seeing, we're not seeing as much as we'd like. I mean, I guess the challenge is, right, they keep saying we're going to go on the totality of the data. And the totality of the data should include the 16th largest bank failing, maybe due to some idiosyncratic unique risks that bank had of its own. But I mean, I think the Fed it would be egregious for them to just ignore the events that just transpired today and yesterday.
Yeah, because the problem is if they increase by 50 now, which I think is the right decision if you target inflation, which is the number one mandate, right? But the problem is that they would invert the yield curve even more. And when we think about of a bank in general, right? So they take the money of depositors and then they invest most of it in bonds, right? And the global bond market is again negative actually for this year, although everybody was talking about it will be the recovery of the bond market. So I think if SVB has this issue, then of course also many other banks will probably have similar issues, right? I mean, every bank is different. I totally get that. But how do you say it? But like I said, you get deposits and you let the money work, right? You invested in bonds, you invested in stocks, you invested in MBS. So I guess how do you say it? Because there are also accounting. I wouldn't say it's a trick, right? But there are accounting things like you can. If you put a security that you buy as I think it's called sales to market or something.
Available for sale.
Available for sale. Thank you. Available for sale, and then to hold to maturity, right? So.
Right.
Exactly. So when you categorize it as hold to maturity, then you don't need to realize any losses, right? So I think so. It would be very, very interesting, to have all the consulting companies like EY to also check all the banks right now, right? To check them properly, and also to mark each of the securities that they hold mark to market, and so I'm just wondering, if the market reaction today was overdone, or if there might really be something to it, because an inverted yield curve is terrible for banks, and if banks go down, we know that then a lot of things or everything goes down, right? And then we will have our recession for sure.
Yeah, you missed some. We talked about it a bit earlier, and that was some of the points I think made about what what are the knock-on effects to whether it's private or venture stage or whatever companies that are now not going to have access to their capital. They're going to lose some of the capital. They're going to have to do some sort of capital raise potentially, and what are the implications? I mean, all else equal, I have to think that the 16th largest bank failing leads to a reduction in related economic activity, which in the VC space, it's obviously kind of had its own challenges with private asset marks still being reluctant to come down. So we had a little back and forth, Greg, kind of noting maybe companies are going to if they have to raise capital, this obviously maybe this gives them some cover to take a down round before eventually hopefully doing an up round as they come public or whatever. But yeah, I mean, it raises a whole lot of questions. There's just not a lot of answers until we see what happens this weekend. I think the best case scenario, you have a well-capitalized player that comes in and whether the transaction can be structured in a way to incentivize not forcing the uninsured depositors to take a loss. Who knows what's going to happen? We've definitely kind of mulled over some curious impacts of this, but yeah, I think more questions than answers at this point.
Yeah, I mean, I would what do you say? Because I'm also thinking about like what would be the next step basically in the escalation of a deteriorating economy, right? Because like I said before, it hit the specs first, then crypto. Now we are in the venture capital phase, right? So the next step would be how do you say, a more maybe a more established bank. Or maybe it doesn't need to be a bank, right? It can be also a very well-established industrial company. And if a well-known brand goes down, then I'm just wondering if that could also trigger, how do you say? I wouldn't say a recession, but at least a huge sell-off, right? So I'm just wondering, like, in what space the next how do you say, what is it called? The next stone will fall.
Yeah, I saw somebody else comment about industrials and then like industrial conglomerates being a likely next, I guess, area to look for some issue here, X other banks. Look, all else equal though, with this happening, you have to think that consumers see this, they see these headlines, right? It's the ongoing drumbeat of recession is coming eventually. And the data seem to show from consumer surveys that their outlooks are deteriorating broadly. If you are less confident about the outlook or your job security, you're going to spend less money. So, will these sorts of things help the Fed achieve that inflation target without the need for short-term interest rates to continue inverting the curve, like you noted? So, it's definitely just continues to be a tough road for Powell and co to trod. And I think that it would be safer for them to err on the side of caution than going full steam ahead with 50 after today. And obviously the market, we talked about it earlier, that has shifted. It's now pricing more likely 25 than 50. We'll see how that evolves over the next week and with whatever happens this weekend. We're coming up on toward the 2-hour mark though. So I know we've talked about SVB and the like to an extent. I'm going to wrap it at 6 Eastern. So I don't know if anyone in the audience had any kind of wanted to talk on any different topics. We can keep talking SVB if people want to, but just a time check, I'm going to wrap at the 2-hour mark. So I'll pause there for a second. If anybody wants to come up and speak, otherwise, yeah. It's like there's just so much we don't know. We can speculate, but I mean, my thinking is that it makes the Fed's job actually easier for this sort of a thing to happen, insofar that it should lead to reductions in the things that they don't want, right? It should lead to reductions in consumer spending, perhaps in business investment. We talked about excuseflation earlier, Giro. I don't know if you've seen that story from the Odd Lots team, but this idea that even with input costs dropping, many companies continue to kind of bump margins and raise prices despite that.
I have to say I don't know this term yet, so I learned something new.
I think it's a brand new term that they coined. It was the first time
I
I've ever
see.
seen it used too.
Okay, cool stuff. Yeah, I was just because if we didn't have SVB headline, right? If we had a super boring Friday, a super normal non-farm payrolls Friday, then actually the data would actually suggest that the Fed would increase by 50, right? Because the additional non-farm payrolls,
Well,
the
I'm not sure
additional
about that though, because I saw that
really,
the moment the report came out, that yields
yeah,
started to drop across the short duration, right? The 2 years started dropping. I mean,
yeah,
it was a good report, but it was yeah, I think it's still too hot for their liking, but I don't know that I would agree that it would have pushed them toward 50. I mean, the market felt the way that the market felt. That's fine. We can
yeah,
have
but I
our own
think it's
view.
more because of SVB, the combination of SVB and maybe the focus not on the how do you say not on the additional non-farm payrolls, but the focus on unemployment rate that it increased slightly from 3.4 to 3.6%. But
Right, which is good,
if
right? You have labor force participants coming back in, so that is good. I mean, the Fed wants to see that.
no, but in order to bring inflation down, actually, they want the non-farm payrolls actually to go down, right? And
Sure, yeah,
the
you're right.
estimate
The
was
headline number itself was more than and I think folks wanting inflation to come down would like to see. But my point being that it does look like people are coming back into the labor market. I did make a point though that at least some, if you look under the surface, there are some places that are looking challenged. I made a point that transportation saw its largest decline, third largest decline in the last decade. So excluding 1 month in COVID and 1 month in 2013, more truck driver jobs were lost in February than in the past decade x those 2 months. So like there's some that's still too hot. Clearly, like a lot of the services stuff, as people just keep revenge spending like crazy. But I put a little like thinking on my personal account out earlier in the week where it's like you've got all the excess savings that are largely getting worked through over the coming months. You've got loss of Medicaid coverage at the end of this month for that kind of freeze where people who were kept on Medicaid who might have no longer been eligible. So there's an impact of, I know it's over 10 million. I don't know if all of them end up kind of re-entering the labor market, but you have some supply response that could happen with that. You've got the student loan repayments starting up some point in the third quarter, right? So like these things are going to happen, and the Fed, of course, knows these things are going to happen. So I know that like when we look at the moment in time, that they would tell them, yeah, they've got to go faster to get inflation. But then when you see these other things happening, I step back and I say, it's a tough job that they have, and they're trying to model a lot of things in a post-pandemic world that's only existed once in the last century, right? So I have a lot of respect for how difficult it is for them, and there's no easy answers, I guess.
yeah. Let me maybe share a quick graph with you guys, if you want. It's about that historically, or maybe you know it anyway, Rod. Like that, the Fed usually always hiked above the headline CPI. I don't know if you know this
Right.
chart table. Yeah, if you don't, let me. So wait. So I think I put it in the nest. So I think now I learned how to do it. Thanks, Rod. I'm sorry.
It's
I'm sorry for the language.
the
Yeah,
Taylor rule, right?
it is actually Korean. Yeah, it is because I'm half Korean, so I tweeted in Korean or I answered another person in Korean. But if you click on this tweet, yeah, there I have a table. I don't know if you were able to open it.
Yep. Yeah, the
Yeah,
point that the table's trying to make is that the real Fed funds rate is behind headline CPI a lot more so than in prior cycles.
Correct. So I think either inflation goes down below the Fed funds rate, right? Or the Fed funds rate goes up, or both, right? The inflation goes down and Fed funds comes up. So I think that depending on how sticky inflation is, right? I mean that will determine the the terminal rate. So I think when they priced the terminal rate to 5.5% or something like this, it was because they thought they had to increase by 50, and that inflation is not coming down soon enough. But of course, there are also many other factors. So if they are worried about the banking sector, then they will think about, okay, we don't care about inflation anymore. It's about saving the system. So yeah, it's a tough job, Rod. No, it's a very tough job to be a Fed member.
So Giro and Rod, before you got right onto this topic, you were on the topic of Giro's question of like what's the next stone? I guess what's the next thing that could go wrong? I'm curious if either of you has a perspective on, the kind of flip side of that coin. Like what areas would be impenetrable? Where will things not go wrong?
Good
I mean,
question.
too big to fail, I think, is still true, right? I made my comment about my personal decision to put some capital into BAC, which I don't see the big financial institutions crumbling. Maybe that's foolish to say, but their leverage ratios are nothing like they were 15 years ago, and they have pretty again, Jim Cramer, right? The J.P. Morgan Fortress balance sheet. I mean, those institutions do have very solid balance sheets. Now, this sort of an issue with SVB isn't the same as subprime. And that we're going to see all these counterparty risks, as far as I know. I mean, I think that the risks are more about what we talked about with the companies who actually have deposits and what's kind of implications for their businesses, as opposed to other financial institutions. So, I would think too big to fail should still hold true. Giro, I don't know if you would push back on that.
No, I actually agree with you. Also, that since the financial crisis, you have much more rigorous stress tests, and the equity that a bank needs to hold is much higher now. But on the other hand, of course, there are always because regulation is always slow, right? It's like it's like in sports doping, right? So they always adjust to the new to old news. So also when they stress test, they actually stress against historic events, basically, right? But they don't stress against newer stuff because nobody knows what the new thing will be. So I agree and not agree, Rod.
I would think, though, to your point, Greg, what's probably impenetrable. I mean, some of the balance sheets of some of these big corporations, as you're probably well aware, are just so incredibly strong. Corporate balance sheets generally, I think, compared to GFC, are in a better shape. So, beyond the unique risk of if one of those companies happen to have all of its cash on deposit at SVB, I tend to think that would be why the market did what it did today, right? That small caps sold off so hard relative to the large players. Maybe the market taking the view that the bigger players, if things are going to go to hell, are better situated to handle hell than the smaller guys.
Yeah, I think there's the possibility of smaller guys find themselves in hell. They can get handed a ladder from someone with a really strong balance sheet and get acquired, right? So there may be a bunch of M&A activity that happens coming out of this. I don't know that I would say that a lot of the companies that are kind of tangential but larger and maybe didn't hold cash with SVB to some of the companies that will struggle due to deposits lost with SVB are impenetrable, but they might have an opportunity. Also, I see that Psych has something. I'm curious what Psych thinks.
Oh no. Well, I kind of wanted to go back to the original, the previous topic. I was kind of curious about your thought process in terms of buying those positions in Virtue. I know you bought some puts on that. What is the difference between Virtue and BAC in your opinion?
Right. So Virtue Financial, I was selling puts on Virtue Financial. For those who don't know, they are basically the public version of Citadel Securities. Citadel Securities, of course, being Ken Griffin's market-making arm, not the hedge fund, the market-making arm. So Virtue also does market making. They compete with Citadel, with Wolverine, with the other market makers. So they face their own regulatory risk overhang. I'm sure you're familiar with the payment for order flow kerfuffle and the proposed rule changes and the like to make it just change those rules, change the regulatory regime. So there's concern that that change is a challenge, perhaps even structurally, to the business of market making. I tend to think that it's better actually to have market makers than to just be charging commissions. I actually think that retail traders benefit from not paying commissions, and by they can opt which broker they want to do business with. And if they want to do a business with a broker who can't think of the word, it's eluding me, who sends all their, if they want to do business with Robinhood, who's going to send all the order flow to Citadel, they can opt to do so, right? Clearly, they don't care that much. Those who even raise a fuss often still seem to do business with Robinhood. So I think it's a lot of noise over something that I don't think is a big issue. The idea of the PFOF not really being a big issue is kind of my view. I think that that they are a financial from a sector perspective, right? So if you're selling that sector, they kind of get dragged down with it. Even though they're not a bank, they're not a financial institution, they are traders, they are market makers. So when I look at that business over like a long duration, they're not far above their IPO level from 2015-ish. They're after today's drawdown, they're I think single-digit % above their IPO price. So the CEO is the same guy who co-founded the company after the GFC or around then. So I like the leadership. I think that they have the right incentives. They actually have a pretty attractive, they have leverage on their balance sheet. Sure, it's like 2.1 times levered to EBITDA, but it's all long dated. They refinanced everything by early 2022. So I think their first maturities are not till late in the 2020s, like 2029 or something like that, maybe 2026 for one of them. But like they have rate caps. They have, I think their average rate, they noted in the last earnings calls, under 5%. So it's like, yeah, they have some debt, but I don't worry about that so much given the structure of it. I think market making is still a profitable business. Like their forward P/E is 7. And it's just one of those businesses that's right now trading really cheaply. I think that there's a lot of the overhang from the regulatory concern, as well as then them just taking it on the chin as the financials sold off the last 2 days. So I made the comment on my personal Twitter, right, that they're not a bank, but they're trading like one. So I wrote a bunch of $17 and $19 strike puts for June. I wrote them because I felt the price was low and the volatility was high. I also bought some calls, bullish risk reversals, because I believe with all of the trading activity in the first quarter, especially on the retail side, right? It's been reported pretty broadly about the uptick in retail activity, and at least Jan and Fed. We'll see how March goes. That they should have a pretty good first quarter when they report results in a couple months. So I'm kind of playing that they have a rebound, in the next couple of months, and I'm happy to hold the stock and own it for years, at a mid-teens cost basis, with a view that they pay a pretty nice dividend too, and they're buying back stock. So total capital return is meaningful. They generate a lot of cash, and even if they're coming off of pandemic highs, so sure, if you screen it, it's not going to show up as a growth company. I think over the long run, you're well rewarded for bearing the risk at these prices. But I'd be happy to hear pushback. I mean, I would love to hear pushback. Not saying you have, just in general.
No, like, long story short, I mean, like, you probably have like more knowledge in terms of like the just like the finance side more than I do. So that's why I was kind of curious. But then like you're like pretty much like explain like I'm 5. What you're saying is the difference between like SVB and like Virtue is like the SVB Silicon Valley had like mass amounts, like what was it, like the 10-year treasury notes, which kind of like reduced
But Virtue's not a
on
bank.
hand.
That's the thing. It's not. It's a financial, yeah, like from a sector perspective, but it's not a bank. They're traders. They're using their own capital to facilitate market making and to try and generate income from trading activities. So they're not a bank. It's just an entirely different business model. I don't envision, or I can't conceptualize like how they would have any sort of relationship with like bank failures, because it's just not their business, right? So they're facilitating market making. Trading activities remain pretty elevated. The idiosyncratic risk would be that they're losing market share to Citadel and other competitors, right? And then the regulatory risk of if payment for order flow changes, is there a structural impairment to the income generating capabilities of the business? I have to think like market making has been around for forever. It will continue to be around. It's not going to go away. Even if it shifts to auctions, like what does that look like? I don't know. Maybe the exchanges end up winning in that, and I'm missing some serious risk. It's possible. Yeah, I know that's not explain like I'm 5, but hopefully that's fair.
Okay, no, I was just like kind of curious, but just to be clear, like looking at your positions that you like posted up earlier, you were just writing puts. That's all you were doing, right? You weren't buying like short-term puts in the meantime, also.
Right, I was selling puts and buying calls. I was selling at the money puts and buying out of the money calls. So I was putting on a pretty bullish trade.
All right. Thanks for that.
Absolutely. But hey guys, look, it's 6 Eastern. I want to start my weekend. Greg, thank you so much for joining and sharing those insights on the AI side. Really awesome to kind of make your acquaintance there, and hopefully gave you some good backdrop on how we think about call writing. It's a very much an opportunistic. I truly mean that opportunistic. It may not happen, for weeks, and then opportunities present themselves, right? Jiro, of course, thank you for tuning in. Psych and Chris, always a pleasure, guys. So just to kind of recap from programming perspective, we're going to cover PLBY earnings on Thursday of next week, as of course we've disclosed. That's for Wook Capital. That's the only public position that we've disclosed. So we will continue to cover the company, even though it is quite hated and loathed as it trades close to its all-time low. We'll cover the earnings call at 4:45. I'll start the call next Thursday, and we'll play the earnings call and hopefully have a good discussion afterwards. I had a good conversation with a large shareholder today, so I can share some nuggets after the earnings call. We, in the following week, are going to do GameStop earnings. I am going to be on vacation. It is my birthday, the day of GameStop earnings, so I'm going to be celebrating my birthday instead of listening to GameStop earnings for the first time in 3 or so years. So that will be fun. And we will, of course, be back next Friday with Wook and Review at 4 o'clock at the market close. And then Wednesday night at 7 Eastern, we do our little open mic chats that Jiro's joined in, and I know some of the other folks in the audience have joined in. So if you follow my personal handle, I have in the audience at Rod Alsman, you can kind of be up to date on that as well. So hopefully we'll catch some of you next week during the open mic or during the Wook and Review. And I'm sure it will be an exciting weekend to see what comes about from this SVB and the ripple effects. Lots of news, I'm sure, will come out. So cheers, everybody. Thank you very much for tuning in and for your interest in Wook Capital Management. Just to reiterate, our ethos, our thesis is that crowdsourcing research can unlock investment alpha, and our goal is to enable a crowdsourced research platform, which we are continuing to work on. Still really coming up on the 1-year anniversary of our first social programming. So we have a lot to do, but we have a lot of exciting things in the works that I'm very eager to share, and I don't want to reveal too much, so I'll leave it there. So cheers, everybody. Have a great rest of your day. Have a nice weekend, and hopefully we'll talk soon.
Thanks, Rod. This was fun. Have a great weekend.
Thanks, Rod, and happy early birthday.
Thank you.
Happy birthday, Rod.